You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. It is a dangerous world out there. Volatility is on the rise, and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit orats.com or email Matt Amberson at matt@orats.com. And now, it's time to learn how to implement options in your practice. It's time for the Advisor's Option.
All right, everybody. That music means it is time once again for the Advisor's Option, the program here on the Options Insider Radio Network. For you, the busy financial advisor or asset manager, maybe you're just coming to grips with these options markets. And we know, you look at the numbers, there's a lot of new people entering this market all the time. Maybe you're looking for a little bit more information and education on these markets. Maybe you're a client and you're saying, what should my advisor be bringing to the table from a skill set and knowledge perspective when it comes to options? Either way, we've got you covered here on the Advisor's Option. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-compelling network upon which so many of you are binging these days. Hey, we love it. We see the numbers every month this year, pretty much the hottest month in the history of the network, 15-plus year history, I might add. So that is certainly saying something. We welcome you all. If you're one of the many on-demand listeners, all we ask that you do keep rating and reviewing on whatever platform you get it on. These shows are literally available on just about every platform under the sun now. And so if you like what you hear, keep rating and reviewing. It clearly does help new people discover the content, and they are legion these days. And of course, if you want to go above and beyond the couple of shows that are coming at you a day, you want more in your life, you want exclusive Pro Q&A. Just got off the hot seat with Mr. Scott Nations, a great Pro Q&A about all things volatility. Check that one out. And of course, Options Oddities every Friday. You want live access to this and every other show that we record here on the network. You want access to the Pro podcast, giveaways, everything else. theoptionsinsider.com/pro is the place to go to learn more about all that. And let's learn more about who's joining us on the show today. First, going out once again to the northeastern volatility mecca. No, we're not going all the way to Maine. We're going one state adjacent. We're going to stop off in New Hampshire. We are joined once again by Mr. Matt Amberson, the founder over there at ORATS, a.k.a. Options Research and Technology Services, a.k.a. the Oracle of New Hampshire himself. Joining us again on the program. Mr. Matt, welcome back to the Advisors Option Program, sir.
It's beautiful out here. No better place to be for summer in New England by the ocean. And the markets are interesting. We got some great stuff for you today. Great questions. Ready to get at it, Mark.
Let's do it. Sounds like the ORATS compound continues to expand as we speak, sir. I'm picturing a palatial fortress in my head now at this point. Is that somewhat close to the truth, sir?
Yeah, I said, hey, we got a little bit of an intro, but then, the podcast starts. So they're used to it, but, they're trying to be quiet, but there's a lot going on here.
Sounds like you're building quite the construction over there. Interesting stuff. And also joining us on the program today, he's been on before, but it has been a while. He is Michael Oyster, the Chief Investment Officer over there at Options Solutions. Michael, welcome back to the program, sir.
Thank you, Mark. Thank you for having me. Good to be back. It's also a beautiful day in the Midwest here today. Getting into the late summer. Kids are going back to school, so it's a beautiful time. Great day to be alive.
Yes. Yes, indeed. Well, Mike, like I said, you've been on before, but it has been a while. The last time you joined us was all the way back in April, late April of last year. So we were pretty much just starting to kick off the second leg of the meme stock explosion. We were kicking off this next gear of the rally in the market. So a lot has unfolded in the marketplace since then. We'll get to all of that in a second. But before we get there, obviously we have a lot of new listeners joining the network and indeed joining the program since your last appearance. So let's start there. Give us a quick overview of your background over there in the financial markets, as well as what it is you folks do at Option Solutions, sir.
Yeah, thanks, Mark. I started in the options business in 1994, working with Bernie Schaefer, who certainly many of your listeners would be familiar with. Bernie's an absolute genius when it comes to options. I learned so much from him in the early days of my investing career. Then spent 19 years in the institutional world working for an organization called FEG Investment Advisors, working with institutional investors on a variety of different investment type solutions. I led the investment effort on multi-billion-dollar outsourced CIO solution that they offered. And then I've written 2 investment books, the more recent of which is called Success in a Low Return World, that came out in 2018. And then in 2019, we started forming Option Solutions. So Option Solutions, we're a specialized asset management firm. We've brought together a number of great options minds with incredible options pedigree to come together to form this organization. We work with clients on a variety of different ways to use options to unlock additional income from assets that they already hold, as well as in your promo at the beginning of the show mentioned, what we're working a lot on right now is hedging techniques, hedging risk away from downside with giving up a little bit of upside. And the other thing we're talking to a lot of clients about now too is this idea that you can get a multiple of the upside in the index or the markets and participate 1-for-1 on the downside. So using options in very creative ways, we're having a lot of fun. That's really what it's all about.
Well, that's what this show is about as well. So let's get to it. Let's kick things off with the P&L statement.
What the heck happened in the options markets since our last episode? Let's find out with the P&L statement.
All right, everyone. Welcome to the P&L statement, the segment of the show that was born out of necessity, born out of the pandemic, because so many crazy things were unfolding in the market month after month that we really spent a lot of time at the top of every show just breaking them all down. So it seemed like it needed to be its own segment. Hence, the P&L statement was born. Michael, it's been a while since you've joined us here on the network. So usually this is the part of the show where we kind of talk about what's happened in between our recent episodes. But your last appearance dates back a ways. So we have a lot to unpack with you. Let's start there. Catch us up. Obviously, since April of last year, we've seen tremendous movements in the markets, tremendous movements in the volatility. The markets obviously shot north towards the end of the year, then shot back down again, and then recently started shooting back up again. We've seen volatility move commensurately with that. So catch us up What are your thoughts on the massive market developments we've seen since your last appearance leading into today's show, sir?
Yeah, if we talked about everything that happened since the last time I was on, we wouldn't have much time left for sure.
It'd be a 4-hour show, yes.
Yeah, exactly. The biggest thing is that for the first time in really 40 years almost, we're seeing an environment where interest rates are no longer steadily declining. And in fact, they're starting to move up. And the repercussions of that moving through markets cannot be understated. You look in 1981 when Paul Volcker was the chairman of the Federal Reserve. He deliberately threw the U.S. economy into recession to stamp out inflation. Interest rates at that point, short end of the yield curve, was up in the upper teens. From that point on, for the next 40 years, we've seen interest rates decline. And people talk a lot about the comparative between now and that inflationary period. That's not what I'm talking about. What I'm saying is that over the course of the 40 years since then, as interest rates have declined, that's provided a tailwind for stocks that most people have gotten so used to that they don't realize that it's not the most common thing in investment history. It doesn't have to happen. And now the reality is taking people by hold, which is to say, wow, interest rates may not go down forever. They probably won't go below zero. But maybe interest rates are starting to move up. So we're seeing that. I know you want to talk about earnings. There's going to be continued revisions to the downside, particularly as it pertains to how companies operate in a higher interest rate regime. I think it puts pressure on stock prices going forward.
Interesting. We'll unpack that a little bit more. Let's go out now to the palatial New Hampshire compound, where we are joined once again by Mr. Matt from ORAS. Mr. Matt, sir, a lot to unpack. A lot has happened since the last time you and I chatted on this show, including this, I think, fair to put it, somewhat remarkable rally that we're seeing out there right now. You were out there calling bottoms for a while. It seems like we got quite the rally on our hands. What are you feeling right now as we're kicking off the show, sir? What are your models telling you?
Yeah, the construction crew's all gathered around for this segment.
There we go. They're listening. They're listening now.
No, I'm still, like, all our indicators are still in a bullish trend. I'm like Michael. There's a lot of problems in the market, including pressure on earnings. There's a lot of pressure on rates. The Fed is warning that they're going to raise, but the market is not really listening. So now I like how everyone says don't fight the Fed when the market's going up, and when the Fed says something bearish, then they fight the Fed. So I think they're going to be awoken to some sorry news when the Fed starts tightening. I do think it's politicized, so I think there's going to be some pressure on the Fed to get us to at least November to the midterms without totally destroying the market. But after that, all bets are off. But, everyone hates the market, but all my signals are just still saying, vols is drifting down. That's great for the market. The contango is still in a healthy position. Our forward volatilities that show when there's some duress in the market makers, they're still looking good. I mean, there's some kinks there. I really want to get short, but I'm not getting there yet. So it still looks pretty good, from a bullish and bearish statement. Of course, there's a bunch of other things going on that I'm looking forward to getting to. I heard you mention the meme stocks, so I'll bite my tongue until asked about it, though.
Well, yeah, a lot to unpack there as well. I like how you put it, kinks. Yes, there are numerous kinks in this market. And you're right, people they don't fight the Fed, but unless the Fed is tightening and you don't like that and you want to just rally the market, then you could fight it all day, apparently, and everyone's on board with that one. So it has been pretty fascinating to watch. Michael, you mentioned kind of the clients who are coming to you right now. I'm kind of curious about that. You guys obviously are interacting with a lot of different people on a regular basis out there. What are you hearing from those clients right now? Are they coming to you in the middle of this rally now and saying, hey, we're really all in on this rally. The worries, the concerns are behind us. We want to go all in. We want bullish, super bullish strategies. Are they coming to you saying, we're a little bit skeptical right now, like Matt was just alluding to? We don't really want to go short yet, but maybe we want to lock in some of what we have with some protective strategies. What are you hearing from the broad cross-section of clients right now?
Yeah, it's both. And I think that's an evidence of the fact that people just don't really know what's going to happen next. It's a brave new world where operating through right now. So yeah, we're getting a little bit of both. Some people say, well, I think like you, I don't think the stock market's going to go up 12 to 15% a year. If it only goes up 5, can you give me some multiple of that? And I'll take 1 for 1 on the downside. Some people are like that. Other people are saying, yeah, this is a dead cat bounce where, it's a bear trap, whatever you want to call it. And we're concerned that there's more downside to go. The other shoe is yet to drop. So can you protect? We'll accept another 5% down if you can protect us from -5 to -20, for example. And we're willing to give up some upside if you can do that. So yeah, we're hearing a lot of that. And then more than anything, I guess, than those two is just people are looking at continued trying to find ways of generating income on stocks that they already have. If they can enhance return of stocks that they're never going to sell, be it a diversified basket or a concentrated stock position, they like to talk to us about that. If we can do a little bit better than the dividend and add a little bit of value, boy, that really makes a lot of difference in the long term.
Enhancing income streams on a stock you may already own. That dovetails nicely with what we're going to talk about a little bit later here on the show. Really quickly, I want to get your guys' pulse on some of our current audience polls right now, our current questions of the week. Our current question of the week right now is, VIX is back below 20 as of the time we posted that. Is this the beginning of a new vol regime or just a blip on the radar? Quite simply, will VIX still be below 20 at the end of Q3? Mr. Matt, I'm curious for your thoughts on this one. If you have a vote, have at it. And more importantly, what do you think our audience is voting for, sir?
I don't know. I'm a target winner from last week. So
yeah, you had a bullseye a couple of weeks ago. So you're looking pretty good.
Yeah.
We had a couple of guests hitting it. Russell got a bullseye last week. You were 2 weeks ago, I think. So yeah, a couple of bullseyes in a row for guests.
Yeah. So I think it's going to go down for a little bit, but then come right back up. Like I said, I think there's a lot of problems out there, a lot of uncertainty out there in interest rates, and a lot of the other segments. This rally is really testing some of the bears, but I think they're going to eventually get the upper hand and then drive the VIX up. So and I think I'm going to say your poll people are with me on that one. So let me know.
Interesting. By the way, speaking of our polls, you mentioned the meme stocks. We did this question of the week last week. We asked our audience, we've seen an explosion of call options paper in GameStop, AMC, Vroom, all these names you've seen before, Be Big, which raises the question, is the meme stock frenzy back? And nearly 70%, 69.3% of you said yes, listeners. Only about 30.7% said no. Mr. Matz, you mentioned the meme stocks earlier. Does that surprise you that our audience thinks we're back, baby? We're back to the last time Michael joined us when it was just meme stock frenzy.
Well, I wish you would have told me that, because I think Best Buy, Bed Bath & Beyond is up 75% and halted today. So now they're getting back, even though Robinhood was sued for some manipulation, it sounded like. They've halted Bed Bath & Beyond, and a lot of these meme stocks are up huge today. Now I get to go back to my favorite graph, Mark, looking at the Russell components and how the calls are versus the puts. I've been quiet on that. Let's just look back here since March and April, and it hit the low in July, kind of late July, that the calls versus the puts, but now they're creeping back up. So for the last month, the calls have been coming up. So they started a month ago, Mark, and they're coming back now. We're higher than let's see, 14 years of history, but we're not quite up to the 2021 November and the 2021 June levels, which got astronomically high. Usually the way out of the money calls are about 80% of the volatility of the puts. Now we've gotten back to par, so it's pretty flat. Back in June of 21 and Nova of 21, it was actually 10% higher. So the calls were 10% higher. So we're creeping back up. So FOMO and all of that is back. So that's how we're sitting, Mark.
Wow, FOMO is back. And I believe, I'm looking at Bed Bath & Beyond right now, up 315% in just the past month. My goodness, up 95% just in the past week. So yeah, there's certainly some Certainly some FOMO afoot out there. Mr. Michael, same question for you, sir. We asked our audience, VIX back breaking the 20 handle. Do you think this is the beginning of a new volatility regime or just a blip on the radar? Where do they think VIX will be? Will it be below 20 at the end of Q3? What is your vote, sir? And what do you think our audience is voting for?
Yeah, and I'm going to side with Matt on this to a large degree. Taking the second question first, will it be below 20 at the end of the third quarter? I'd say yes. High probability of that. The long-term average is 19, so it's really difficult to say. It could be above, it could be below, but I'm going to say below. And the reason is because we're seeing a trend in that direction. People are still not waking up to the idea that this is a harder environment to invest in than has been in the last few years or so. So I do think there will be that, but then there's some seasonality that could come into play after that. October is sometimes a really difficult month for the market. So pretty much what Matt said, you see a decline. I think it will be below 20 at the end of the third quarter, but then I wouldn't be surprised to see it pop back up. In terms of the first question, are we in the beginning of a new volatility regime or just a blip on the radar? What I'm seeing is, and historically, Mark, this, there's about 5 to 7 year periods throughout history of the VIX where it tends to be in one regime or the other. You'll go for a long period of time with low volatility, and then you'll spend the next 5 years up and down, of course, but tending higher. I think from the beginning of 2022, we very well could see the makings of a new higher volatility regime. It's been above the long-term average virtually every day so far this year, and we're all the way into middle August already. So I wouldn't be surprised if what we're seeing here is a short-term decline in volatility, only to be followed by a move back up above the long-term average of 19.
Interesting. Let's see what our audience has to say on the issue. And right now, almost exactly 2/3, 66.7% of you are saying no. VIX is not going to be back below 20 at the end of Q3. Think we're going to be higher. 18.4% of you saying yes, and 14.9% choosing our third option of VIX is confusing. I can certainly understand that given what we're seeing out there right now. Meanwhile, though, we were just talking earlier about ways to increase the income on some equity positions you may already own. That sounds like a perfect time for an Options 101.
It's time to learn how to manage risk and generate additional income for your clients. It's time for Options 101.
All right, everybody, welcome to Options 101, the portion of the show where we break down some options concept or technique or strategy, explain it in a little bit more detail, and explain how you can utilize it in your clients' portfolios. And today's edition covers a topic, a strategy we haven't really touched on the show in the past, which is saying something. The show has been running for some time, and it dovetails with that theme Michael was putting down earlier about ways to generate additional income from some equity positions you may already own. So, the go-to position for a lot of advisors to generate income, that is, of course, the covered call. I'll give you a quick example if you're one of our many new listeners, even though most of you are familiar with the covered call already. Everyone's favorite name, XYZ, trading at $100. Your client's long 1,000 shares from 70, so he's doing pretty good. He's pretty happy right now. But you, as the advisor, believes the stock's going to languish around $100 for the next couple of months. Just going to sit around. What can you do to maybe juice up your returns in the meantime? Your client decides they're comfortable selling the stock at 110, so you come out, you sell a 1-month call at the 110 strike, and you get $1 for it in our example. So a pretty nice chunk of change out there. So obviously you're doing 1,000 shares, you're doing 10 contracts, you collect $1,000 for this trade. Nice little chunk of change. And you agree, obviously, to sell that stock at 110 if it goes off. So you collected $1. So your effective sale price if the stock does rally is 111. So intriguing stuff out there. You're all familiar with that strategy. I won't belabor it here on the show. If you're not, again, go back into the archives. We've discussed covered calls many times, including most recently on Michael's last appearance on the show. They do kind of specialize in covered calls over there at Option Solutions. But now, what if we go above and beyond that? What if we want to add more income? That $1 is not enough. It's not floating your boat. It's not getting your clients excited. What if we want to upgrade to a new position has many different names. For this show, we're going to call it the covered. I put covered in air quotes. You'll see why in a second. Covered combo, covered strangle is another way for it. So you've already heard one leg of this. You sell the covered call. That's the covered part of it. That's really the only covered part of this. That's why I put covered in air quotes for this new position, because now we're going to add on to that. Let's say, same scenario, your client is long the stock, but maybe he doesn't mind buying a little more if it dips a little bit. If it dips back down to, let's say, 90, he doesn't mind adding a little bit more, actually, to his position. So in this scenario, in addition to selling the covered call at 110 for $1, you're now going to turn around and also sell a short put. And this is going to be a cash secured put because you're going to put aside the money to buy the stock, but you're going to sell a 1 month put on the 90 strike. In this case, you also get $1. Let's make the math nice and easy. But in this case, your client doesn't want to double his position, so you only sell 5 contracts, I should say. So you're going to buy 500 additional shares if the stock does drop there. So in this case, you collect an additional $500 to do this trade. Now, why would you do this? Well, the benefit is obvious. You're collecting more income. You've made 50% more income for not doing a heck of a lot more for this trade. The downside, of course, you have more risk. It's covered, but really only covered in one direction, which is to the upside. If the stock rallies, your stock will get called away. To the downside, on that 90 strike, you will be buying more stock. So that's something you have to discuss with your client and decide if they are comfortable doing that. And that will, of course, dictate the strike where you sell that put at as well. You have to find a level where they are comfortable acquiring more stock. And now we get into this new covered combo / strangle position. Let's go around the horn. Let's start with you, Mr. Matt. What are your thoughts on this position as a whole? The fact that folks call it covered, even though it really isn't. And then also its overall utility for the advisors as a tool for generating more income for their clients, sir.
The Texas Strangle. You're already long and you're getting longer. I mean, in the accumulation phase, if a client is accumulating stock, yeah, I mean, they could accumulate more selling. And I like that they're not selling, the full boat. But, you already have risk to the downside, obviously, with the stock, and you're selling more. So, but, a strangle is a good way to, especially in this type of a market, to get some extra money in. Of course, we've talked about this many times in the show. I like to back test and look at these separately, like the calls and the puts. Strangle doesn't have to be in the same month and same amount out of the money. So I like to look at those separately, as I've learned back in market making days when we used to look at every tick and simulate gamma hedging strategies. Every stock has a different way of moving, so you really have to test and look at each one or look at similar groupings. So, before we get into a strategy or a client does, we have these optimizers that run, thousands of back tests and helps, look at some of those delta ranges. So, I think it's pretty risky. I'd rather do, call spreads and put spreads, but some people are the people that are making a lot of money are taking the most risk. But for my money, I like to have at least some protection in there. Why not sell a put spread instead of a naked put? So that's my feeling on it, Mark.
Indeed. You mentioned the Texas Strangle at the top. Why the Texans get beat up all the time? Why is it a Texas hedge? Why do we always assume people from Texas do not know how to hedge?
They want everything big.
I guess they want everything go big or go home when it comes to Texas. Michael, same question for you. You kind of mentioned doing this earlier, not this exact strategy, but looking for ways to increase income for your clients on equity positions that they already own. What are your thoughts on this way to do it? The covered in air quotes combo / strangle / call it what you will. And then we'll get to maybe some other ideas in a minute.
Yeah, sounds good. Mark, this is something that we do for clients, this exact strategy. And it's really interesting. There's a lot of things to like about it. You mentioned income, and certainly that's clearly a reason why you would do this. Looking at that in isolation, it's clear to see that income is a really good benefit of doing this. If you take the longer term view and you said, okay, what if I implemented this consistently and applied the same methodology for a period of time, then you also benefit from really good investment discipline of rebalancing. So not only, as you mentioned earlier, if your stock goes up, it'll get called away. That's selling high. And then when you're implementing this strategy, maybe you sell puts, for the first 4 or 5 months and they don't get assigned. suddenly the stock drops. If you like the stock, sure would like to buy more of it at that level. That's disciplined rebalancing as well. So that's an added benefit to the strategy that you can only see if you apply it consistently through time. And that's what we do, this exact thing for clients. When we sell puts, you didn't mention this in the strategy as you defined it, but we've got the cash set aside so the put is fully cash collateralized. It's not naked. And we're much more comfortable with that kind of a strategy, having the cash to the side. And then the final thing that I would say about this that I like a lot is that you mentioned you're only selling puts on half of the size. Well, let's play an example out. So let's say you like the stock, it goes down from 100 to 90, and you say, boy, maybe I don't want to buy it at this level. It looks like it's going down. You don't want to overthink it. That's how you implement the strategy in a disciplined way. But if you wanted to, you could theoretically buy back 5 contracts, buy back 5 puts, and then sell 10. And then maybe the price you get from selling 10 is enough to buy back the 5. And now you've lowered your strike and you've made your effective purchase price that much more attractive on a stock that you already like. So there's a lot of flexibility that can come from the strategy. I like it a lot. I think the way you laid it out is really interesting.
Well, there you go. I'm glad you're a fan. We did lay it out as cash secured. That is the way I think a lot of our advisors would do it. It's certainly kind of the approach most of them would take. Before we roll out of this segment here, Michael, any other interesting ideas or nuggets you want to leave with our audience in terms of other interesting ways they may want to add income for their clients?
Yeah, so like I mentioned once before, there's a growing interest around these structured solutions that provide clients with the opportunity to participate more fully on the upside if the market goes up, and then participate one for one on the downside. We're seeing a lot more interest from the advisors that we're working with and individual clients and something like that. They think, okay, we're probably not going to get 15 to 20% returns from the stock market. If I say I'll give up, I want to make, call it 3 times the return of the S&P up to an S&P return of 5%. The S&P goes up 5, they're up 15. So now they've instead of being up 5, they're up 15, and that's great. If the market goes down, well, they're only down 1 for 1. We're seeing a growing amount of interest in strategies like that.
All right, let's see what else the market is expressing interest in. It is time to head on into the earnings volatility report.
Earnings announcements can move markets, but what is the options market telling us about upcoming earnings events? Let's find out with the Earnings Volatility Report.
All right, everyone, welcome to the Earnings Volatility Report. We put out a lot of earnings data throughout the cycle over there at theoptionsinsider.com. If you want to check it out, head on over there, click on the Options News and Articles tab to begin your journey to the dark side. Be forewarned. It's a lot of data. It's a lot of interesting stuff. So if you're intrigued on how these names are performing right now, how they performed in the past, what they're pricing in for the future, it's a good place for you to head on over. Mr. Matt, you are the keeper of all that earnings data. We are in the middle of it right now. We are hot and heavy in earnings season. Big names popping off again this week. A lot of big box retail, Walmart, Home Depot. Walmart looks like it's lifting the market a bit today. We got the Target tomorrow, Lowe's. We got Kohl's coming up later, BJ's. A lot of big box retail coming up this week. What's been catching your eye so far in a very hot and heavy earnings season, Mr. Matt?
Yeah, it's been interesting. Walmart, interestingly enough, pre-announced a bunch of times, warning, and then beat those lower expectations, so they're up today.
Funny how that's the old Microsoft strategy, yeah. Right? Downsell. Oh, wait, we beat it. What a surprise.
Yeah, so that was an interesting way to do it. But yeah, I mean, it does just feel like we're in a late stage of a business cycle here where, the consumers still have some money in their pockets, but it just feels like margins are getting squeezed and earnings have been kind of mixed. We go in periodically and look at the distribution of earnings announcement moves and then adjust accordingly. We adjusted up a little bit, so you may have noticed that the returns for this earnings season look better than normal. I'd say a few of those percentages is due to our distribution, but it's been, there's been some decent returns. There's been lower expectations early of the moves in earnings, and those were beaten. And plus this, though, I think it's so interesting. We've had so many earnings seasons with pumped up volatility, whether it's COVID or the market going down. But this is an earnings season where the market, where vol is coming in, and that extra volatility that's usually in these earning stocks is not in the earning stocks. So we're seeing more beats for the owners of straddles. And I know that's a couple things going on at the same time, but hopefully you understood that. So this is a lower market volatility regime for this earnings, and it's generally better for people that are owning options. So they're doing a lot better. So hopefully that all makes sense after this whole COVID, some of these other months, earnings season months, where the volatility was so high, the market in general, that the companies were having trouble beating their implied earnings move. So hopefully that makes sense. And then we're getting a little we're into the fifth week here of normally a 6-week earnings season. So we're starting to wind down, so we're coming to the end of it now. We're seeing some higher volatility stocks showing up, but we'll see what's going to be going on for those next couple of weeks, Mark.
And Michael, same question for you. I'm curious, as you're out there putting together your various income strategies, I know a lot of it is on broad indices, so maybe earnings season isn't your entire focus out there, but it certainly does impact the volatility spectrum. What are your thoughts on what we're seeing out there right now from an overall earnings volatility perspective, sir?
Yeah, certainly. And actually, we spend a great deal of time looking at earnings on individual companies. We do not too much on index options, actually. Most of what we do is on the equity world and looking at the volatility in earnings and just the uncertainty around the future of earnings. I think if you listen to the major financial media and you hear people talk about earnings revisions and expectations of downward revisions, yeah, maybe on the surface a little bit. But if you look at the projections individually by stock, it's hard to find one where anyone thinks that earnings are actually going to contract over the course of the next year or so. It's a positive earnings trend still. So I think there is a little bit of downward pressure with earnings adjustments and with earnings in general, but I think it still will be positive, which, coincides with our thesis on the market in general, which is, yeah, we're going to have some hiccups. It's generally going to be positive. It's just not going to be the runaway stock market performance that we've seen over the course of the last few years or so.
Let's see what things are running away with your attention span. It is time to get the buzz.
Busy financial advisors don't have time to follow the latest developments from the options market, so we do it for you. It's time to get the buzz.
All right, everybody, welcome to The Buzz, the portion of the show where we break down some of the interesting stories that may have slipped under your radar from the world of options while you're busy managing your clients' accounts. And we get it. It's a busy time right now, so you should be focusing on that. Let us focus on the news for you out here. And the big story that's really been top of mind for a lot of people in the option space pretty much since the pandemic began, and certainly continuing into this year, is can this options explosion, tsunami, this retail revolution, call it what you will, can it continue from a volume perspective? And so far this year, the answer has been yes. I mean, at the end of last year, we were close to 10 billion contracts traded in the U.S. here. That was a record by just about any metric you can look at, blowing the doors off the previous year, 2020, which was also a record, around 7.5 billion, I believe. Somewhere in that range. So everyone thought coming into this year, can this party possibly continue? People are ostensibly supposed to go back to work. They can't trade all day anymore. Hopefully the pandemic will somewhat be receding. We're still seeing new variants all the time, but hopefully things will open up a little bit again, and maybe that will have a negative impact on overall options volume. Yet so far through this year, the numbers have been pretty robust. We now have the numbers, of course, for July, the most recent data that we have from our friends over there at the Options Clearing Corporation, aka the folks who take the other side of all your trades. And July might be the first chink in the armor there, even though they were clever over there at OCC. They kind of buried that lead. The headline they put out is average daily volume for July up 3.6% year over year. And that is true, and that is very important. But if you dig a little bit deeper, into the numbers, you'll see that total volume for July was 742 million contracts, actually down 6.6% compared to July of 2021. Now, July of 2021, no slouch. Obviously, it was still very much meme stock 2.0 time, so things were trading hot and heavy, fast and furious. So it's a rough thing to compare to, but still, year over year, we have managed to beat most of those months for 2021 until July. So interesting, kind of a mixed message coming out of the market in July. Overall volume down, yet average daily volume managing to remain strong. So again, kind of mixed signals. Mr. Matt, we'll start with you maybe. What are your thoughts on what we're seeing out there, kind of the mixed messages coming out of the options market from a volume perspective for July, sir?
For a long time, I've said that quantitative easing is very good for options, but we're getting into some QT, quantitative tightening, which is not going to be good. I think we're starting to see that rising rates in QT is going to stem the tide of options growth. It's been amazing, but I think it's gonna slow down, Mark. So that's been my belief and continues to be.
All right, and Michael, same question for you, sir. This has been something we've been debating on the network all year. You know, can this options party, can it continue? And so far, the answer is yes, for the most part. Again, the numbers for July kind of sending a bit of a mixed message. What are your thoughts on these numbers we're seeing from July, and what are your thoughts overall going forward? Do you think 2022 can rival the epic year that was 2021?
Yeah, short answer is yes. But I'm also with Matt in the sense that I do think you could see some waning over, shorter periods of time as these meme stock investors realize, oh no, buying these options on these stocks that don't always go up, that's not really all that great of a strategy. So maybe they're back to work, like you said, and maybe, they realize that it's a lot tougher than what it may have seemed when the stock market was going up. I do think the other side of this too, and it's easy to point to retail investors and the younger investors, meme stock investors, what have you. There's a growing interest in options from the institutional world. You look at public pensions, for example, there's a number of them that have adopted options-based strategies for the same reason that everybody else does, right? I mean, their actuarial returns are difficult to hit, and they're looking for income, and they're recognizing that they may not get it from stock market price appreciation. So yeah, there's growing interest from the average investor, individual investors, but I think the institutional marketplace is waking up to options as well, and we're seeing a lot of interest there as well.
But Michael, I'm not sure if you got the memo. Stocks can only go up, sir. At least for right now.
Oh, yeah.
They can only go up.
Exactly. Yeah, there's a lot of anchoring. I've studied a lot about behavioral finance, a lot of people have, and this idea that the preconceived notion that stocks always have to go up 10% a year is something that's a very dangerous concept, and I think it's people are starting to wake up and see that that's not always the case.
Well, let's see what else you folks are waking up to. It is time. Our mailbag always overflows on this show. Let's see how many of you we could squeeze in the time remaining. It is time to open up our office hours.
It's time to answer your pressing questions about options. It's time to start our office hours. You can become a part of this segment by leaving a question on theoptionsinsider.com. Emailing us at questions@theoptionsinsider.com or via social media at twitter.com/options, facebook.com/theoptionsinsider, or stocktwits.com/optionsinsider.
All right, everyone. Welcome to our office hours. This is where you folks take the reins, your questions, your comments, your insights. Many different areas you guys want to cover on the show today. We'll see how many we can get to. Let's start off with this question from Ray. Ray C. says, hello. Well, hello, Ray. Says, my question pertains to the inverse VIX product, ticker SVIX. Yes, we are familiar with that one, Ray. He says, it's a tough product for many investors to grasp. Also, this product category is littered with the wreckage of broken products that attempted this in the past. I like it. You're conjuring some good imagery for our listeners there, Ray. I appreciate that. He said, I would like to know your thoughts on this product category and its suitability for advisors to include in client portfolios. Thank you. Well, this is a very contentious product category that you have picked here, Ray, for some of the reasons that you littered out, not the least of which being, of course, the infamous implosion of XIV back in 2018. Took a lot of client funds with it. A lot of people were investing in that product that clearly really had no idea what they were buying. That's why a lot of people were, quite frankly, reticent when this new SVIX came along. There were a lot of people, many of them on this network. Go check out Options Playbook Radio. Brian's made his thoughts very clear on SVIX, that it should not exist. So there are many others like that in that camp. Very people who have been in this industry for a long time who think this product should not exist. It is too dangerous. Others who think it's a great thing. So I guess that's why we have a marketplace. People can express their views and their ideas, and they can trade it or not trade it here. But it is an interesting one, obviously very contentious. We've talked about it on the program in the past, but it's been a little bit. Let's go around the horn and get everyone's thoughts on this. You know, Michael, you haven't been on since this product was listed, so well before that. So obviously, let's catch up there. What are your thoughts overall on SVIX? Are you a fan? Are you not a fan? And then B, as Ray C puts it, what do you think about its suitability for advisors to include in client portfolios?
Well, Mark, I agree with you that we have a marketplace and people can buy and sell whatever they want. But Ray, to answer your question, I wouldn't touch this thing with a 10-foot pole. I think it's not only dangerous in the sense that it's difficult to understand. The risks are masked by periods of performance when it looks like, and I'm not super familiar with this one individually, but I know the type. It will mask the risk by looking at past performance where it plods along and seems to do pretty well, and all of a sudden you wake up one morning and it's down some astronomical number. It's really dangerous. I don't think that it's suitable for investors unless you've got someone who is uber sophisticated and understands the risks and are willing to take them. Your average client, absolutely not, wouldn't touch it.
Mr. Matt, I know you played around in your own accounts, dabbling in some options on SVIX. What are your thoughts, though, as Ray puts it, its suitability for advisors to include in client portfolios?
Yeah, it's not very suitable. And I still harken back to some of my clients, smartest guys that I've seen in the space, and they know more about these. They know when they're trading. They know if they're getting front run or not. They know that they know the prospectus back and forth. There's such an inequity in the amount of information that you could know that I would definitely stay away from these. And you can put them out there, but I think they should come with a huge warning label, as we're saying here, that stay away from these unless you really know everything about them. You've read the prospectus and but then even if you have the prospectus, you don't know what the bank or the person that's put it together is going to do. So I'm with Michael on this one. Stay away from them, Mark.
All right, let's keep on rolling. We have embarrassment of riches, many different topics: early assignment, taxes, volatility, crypto. Let's see. Let's go. I guess we'll do this one here from about early assignment from CZ Office. He or she wants to know, I've heard that the early assignment risk for option writers is the highest for at-the-money strikes. Is that true? Also, what if I write an option that is already in the money, maybe even deep in the money? How does that impact my chance of early assignment? Early assignment, it is funny how often people really fixate on that risk. It's not something that really usually comes into consideration that often. And when it does happen, usually it's a pretty good thing for you most times. Remember, listeners, there aren't many really good times to exercise an option early because you could always go and sell it in the marketplace and collect all that time value. So if you're exercising an option early, you are surrendering that. So on the flip side of that, you are getting a nice little bonus there. Of course, dividends are the time when it really kind of gums up the works a little bit. But outside of that, there really aren't many times that it makes sense. That said, let's go around the horn. Let's go to perhaps Michael first. Is this a concern you hear from a lot of your clients there? Are they concerned? Are they even aware of this notion of early assignment? And what do you have to say for Mr. or Mrs. CZ Office here, who is concerned about the various levels of early assignment risk as you move up and down the strike chart there, Michael?
Yeah, I would say that to answer your first question, many of our clients are aware of early assignment risk, and from the standpoint of if it creates a painful tax event, then that's something they will try to avoid. My experience has been that in the money options are more likely to be assigned than at the money options, which is in contrast to what CZ Office was asking. The in-the-money options tend to get assigned more quickly when there's no premium left and the delta on the option approaches 1. And you alluded to the dividend as well. I think the day before the ex-dividend date, if the dividend is high and you're close to expiration, you will see, in many cases, early assignment that may not make sense from the standpoint of the options economics alone, but coupled with the dividends that they would receive after going ex-dividend the following day, does make it economically feasible for some people to do. So if you're concerned about early assignment risk, definitely keep an eye on when the stock goes ex-dividend, particularly if you've got an in-the-money call.
All right. I think you hit that one pretty well. Let's see if we can squeeze in another one here. Let's go out to this one. Matt, this one is for you. This comes from Marcos. He says, hello, all. Love the program and enjoy the Oracle of New Hampshire's regular volatility breakdowns. Well, you came to the right show. Marcos says, I look forward to it every month. I think I have more of a theoretical question for the program. My favorite option strategy is the covered call. I've been learning more about volatility this year, and I'm intrigued by the idea of trading covered calls on VIX, given the tremendous call premium. Is this even possible? VIX options are cash settled, and there is no VIX underlying that I'm aware of outside of the futures. Is there a way to trade covered calls on VIX, or am I simply wasting my time? Thank you. This is interesting. We had this discussion come up earlier on our pro Q&A session with Scott Nations as well about the notion of covered calls on vol products. I guess this is the flavor du jour. Everyone wants to know about this trade right now. So, Matt, first off, Marcos, clearly a fan of yours. So there you go, a feather in your cap from Marcos. And then what do you think about his question about a strategy outside of today we don't really hear about a lot, which is covered calls on VIXer?
Well, now that of course, for a fan like this, I had to run off and do, couple hundred tests on the VIX and cover calls and such. Obviously, you can't do a cover call, but you can do a poor man's cover call where you buy an in-the-money option, so it mimics the stock with high delta, and then you sell a out-of-the-money call against it. And when I saw this, I go, this is not going to work because the VIX, the roll down is just so brutal on the VIX that you have to be really careful with this. And actually, what my back testing has shown, and kind of what I thought intuitively, was instead of doing a long call spread, actually the short call spreads are a lot better. So tested a bunch of those, and really that's the way to do it. So you want to be you want to get this roll down, and you want to do it when the vol is kind of low, VIX is below 20, and there's contango in it, so it's going, so the front months are going down and down and down, and so it's actually a short call spread that you want to think about. And then one thing that I didn't try that I might is a poor man's cover call diagonal with the long call that's extremely had many days to expiration. The problem is those days to expiration, those volatilities or the implied VIX future gets quite high, as we've seen, but they're actually pretty stable over time. So that might work, but I would stay away from this. Again, pretty heavily tested in the back test, and what I would consider more as a short call spread rather than a cover call more.
Yeah, I like that a lot better too. Much less in terms of capital intensive. You don't have to own that meaty call and sell the other one against. It is intriguing that now that you bring it up, though, the notion of the what we call in the network the fig leaf, or the kind of synthetic covered call, going farther out with more of a stock or underlying substitution type play, a deep in the money call, and then using a nearer term covered call again. That'd be interesting to see the back testing on that. You're right. The longer term futures are extremely bid right now, which is something we could talk about in a future show as well. Market pricing in a lot of concern. Usually it ends around the midterm elections. This year it goes all the way through the end of the year and into next year. Looking at some of those futures, they were at about 28 or close to that, getting into Q1 of next year, which means the market pricing in a little bit of juice. So if you're going to go buy those futures, it's going to be a little bit juicy as a result. But that's an interesting way to parse it there. Mr. Michael, anything you want to add here on Marcos's question about covered calls on VIX and the suitability therein, sir?
Yeah, and I was thinking when he was talking about using futures The risk with that, of course, is basis risk. When the VIX goes up, the spot VIX goes up, the futures invariably, occasionally when the VIX goes up really sharply, futures don't follow suit to the magnitude that the spot does. So it's a really difficult strategy. I can see it working in theory, but it would be, I think, in my opinion, very difficult to implement. But yeah, go for it if you think you can do it.
All right, everyone. Unfortunately, that music means we've come to the end of another epic journey through the world of the advisor's option. Amazing how quickly an hour flies by when you're having fun talking about covered calls on VIX and inverse vol products and covered combos and all the other fun we squeezed into the show. But before we go, let's go back around the horn. Michael, as our guest, we'll start with you, sir. If folks are intrigued, they want to reach out, see what's going on in the world of option solutions, where should they go? What should they do?
Yeah, so optionssolutions.com. Just as simple as that. Options, plural, solutions, plural.com. We're on Twitter. We're on LinkedIn. Connect with me on LinkedIn if you're interested, Michael Oyster. Would love to learn more about what other people are doing and seeing.
There you go. Optionssolutions.com, the place to go to learn more. Mr. Matt, if folks are intrigued, they want to run some back tests, they want to check out some earnings data, or maybe send you some crazy trades to back test, where should they go? What should they do?
Yeah, orats.com. We have a lot going on. So, I appreciate Marcos and all of the clients that have written in from the show. We have quite a bit of volatility research, including now we have a minute-by-minute API. So I've gotten my hands on that, and we're moving our longer-term volatility research into shorter-term volatility research. So that's a lot of fun. I've been testing that. It's an amazing database that we have now. Imagine you could just look and pick out any minute in time over the last 2 years and get the exact volatility and open interest or whatever. So it's a really killer application of our database API. So people should go to orats.com to check it out. And our dashboard product, people are really liking that. You can see payoff pictures of trades. You could scan for certain trades. So we have a lot going on. Of course, the back tester is there too, Mark. We've just given everyone more stuff to use.
Check it out for yourselves. Orats.com, ORATS.com is the place to go. Give them a follow on Twitter while you're at it as well, at OptionRats, all one word. Easy handle to remember, Option Rats. And of course, you know where to go to learn more about everything going on with our friends over there at OIC. Optionseducation.org is the place to go. Click on that advisor tab if you want to see some interesting research and data and strategies that are specifically suitable for you folks in the financial advisor category. That's going to do it for us today on the advisor's options. Also going to do it for us today on our broadcast for the network. Of course, back again tomorrow. Like I said, not sure about the live status. We're going to be coming at you from the SIBO for Options Bootcamp tomorrow. Not sure exactly if we'll be able to stream it live. You will get it live to tape on the on-demand side. In any event, of course, Options Playbook Radio coming at you. And then throughout the rest of the week, your usual shows. And back again soon for another episode of The Advisor's Option. Stay safe out there, everybody.
Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit ORATS.com or email Matt Amberson at matt@orats.com. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.